Hi, everyone. Just before we get going, I want to remind you that everything we talk about and discuss should not be considered as investment advice. The purpose of what we talk about on Catherine Murray Media and Markets on YouTube, as well as Catherine Murray in Conversation With on my podcast, should be viewed as informational and entertainment purposes only. Please definitely do your own research, your own homework, and definitely consult an investment professional before making any investment decisions. And also to note, some of us might hold positions in some of the stocks that we discuss. Great, Joey, great to be able to catch up with you. Certainly there's been a lot going on from a central bank perspective, policy perspective, that of course the Fed last week and the BOC the week before. Really the only large central bank in the world to kind of start pulling back on the bond buying program. So maybe we should just kind of start there in terms of what you're seeing and what you expect to see from central bankers.
Sure. So the Bank of Canada did move first. In some ways, you could argue, well, their bond buying program was more aggressive than even what the Fed was doing. At the pace of their borrowings, it was actually interesting to watch. The Bank of Canada borrowings were pretty much taking up all the extra debt the federal government was issuing. So you can kind of look at that in many different ways. I mean, the central bank's doing that to obviously stop deflation from happening, and that's why they're monetizing debt. At the same time, you got lots of bonds coming into the system. So it's kind of balanced out that way. But the Bank of Canada is getting up there in terms of its ownership of the overall market. I think upwards getting close to 50%. The Fed's not there yet. So that's why, and I think, Mack had said this before, he needs to pare it back probably sooner than expected because of that. Because once you start owning more than half of the market, you start getting liquidity constraints in the market and it causes lots of pricing problems. So that's why I think they started to pare back a bit earlier, even though when you look at Canadian's economic recovery is slower and are coming out of the pandemic is going to be slower, they had to move a bit sooner than expected maybe.
So Joey, I got to unpack a lot there for our viewers to understand it and make sure I'm understanding as well. So
sure.
In other words, the pullback in the bond buying program, in other words, Canada, the Bank of Canada putting liquidity into the market to make sure we've got a lot of stimulus, a lot of money sloshing around so that we can get through this economic recovery. They didn't pull back because the economy is so great. They pulled back because they were buying too many bonds.
I think it's a bit of both. I mean, the economic recovery in Canada has been pretty good, all things considered. I mean, the federal government has provided a lot of stimulus already, and that's definitely helped a lot of Canadians get by through the last year, and they're continuing to do that. So I guess when you look at the actual GDP numbers, we're down maybe 3% year over year. I don't have it in front of me, sorry, but we're not down where we were at this point last June. I mean, a year ago would look things a lot worse than they do today, and obviously we are seeing lights on the horizon, so to speak. So I think that's also the Bank of Canada saying, you know what, we can start to pare some more back. And remember, they had already cut back on other programs already that just weren't being used, like the BA purchases and shoring up the money markets. Those programs went away as soon as they were no longer needed. The monetization of federal government debt is more about sort of inflation and stopping deflation, but that can only go on for so long too.
And so, Joey, but to describe the mechanics of this, right? Canada issues bonds,
right?
And the people who buy them will be maybe pension funds, institutions, maybe international, and all depends on the credit risk of the country and the interest rate that's being offered, the price of the overall yield of the bond. And, countries, institutions pair that in terms of their long-term liabilities, so pension funds and funding their government. And then they can go around the world and decide which country's bonds do I want to buy. That's the buyer. So the country's issue, then you've got that kind of buyer. Mm-hmm. But what we're talking about, so that everybody understands, going back to the financial crisis, you've got the various central bankers in the market buying up those bonds as well. Can you just describe, it's almost counterintuitive to think, okay, my government's issuing these bonds for other people, but they can't take up all the slack. So then we've got another institution, the central bank, that has to buy them.
Yep. Well, it's two things. I mean, the majority of Canada government bonds are actually held by Canadian institutions. So the biggest buyers, it's either our pension funds here or our mutual funds here. If you own a bond mutual fund, 1/3 of your holdings are pretty much in Canada government bonds, right? So that's where all this money is coming from. As the government of Canada need to issue a lot more bonds, at the same time, what happens then is if they're issuing bonds, they're taking cash out of circulation for lack of a better description, right? So that can cause some monetary problems. So, you get an inflationary situation where government starts to squeeze out private enterprise, et cetera, without going too deep into the economic foundation to it, right? when the central bank steps up and buys those, they're doing the exact opposite. They're putting more cash out there to free float, right? So because of that, you kind of keep better liquidity in the system, and you stop, basically it's trying to stop deflation. It's almost like you're printing money, because the Bank of Canada is issuing bonds and getting cash, and the Bank of Canada is basically sending cash out to help fund the government to do that. So it's very much a monetary phenomenon that we're dealing with here, but that's what they're trying to do. They're trying to basically push more cash out there to stop deflation from happening.
And I know we're getting into the weeds, and I'll stop on this weed, but the reason why I'm trying to point it out is because, and look, this is what you want your government to be able to have the tools to be able to do all of this, especially in difficult times. But the point is that this has been going on essentially since the financial crisis. We really could never get out of the way in terms of the goal was to see inflation. We didn't see it. Now some people say we are going to see inflation, maybe even hyperinflation. Just look at the lumber prices. So I'm just trying to say, I guess, but I'd like your take on this, that there's a lot going on underneath the surface. Everybody gets excited that maybe they're getting a free lunch right now, but that free lunch potentially comes at a huge cost. Just everybody be aware, and we don't know how this plays out.
No, it's the market has priced in rising inflation. Like, let's make no mistake. When you look at when the U.S. is a great example, we've got real return bonds, TIPS in the U.S. They're at negative yields when we've got government bonds at positive yields. That difference there suggests you're going to get inflation of 2.5% to 3% over the next 20, 30 years. I mean, that's a step up from where we were before the pandemic, but it's not a huge leap. I know we can look at lumber prices, we can look at food prices, and a lot of things have really spiked recently. The central banks are looking at it as temporary, pent up demand for certain things. We can see it. I'm home right now. I need to rebuild my deck, so I need lumber, and everybody else isn't going on vacations. They're rebuilding their backyards. So yeah, you've seen this little spike in certain parts of the market, but the overall level of inflation still isn't there quite yet. You've had a blip, but there really is a stated intent of central banks, in the US and Canada, to really push inflation higher. And this is how they're going to try and do it, by just printing money effectively, for lack of a better description. How long they let that last before they eventually turn off the taps and hike rates. And that's where I think the danger really is. So we've got, very low rates right now, lots of cash in the system, banks willing to lend, you'd hope, lots of alternative lenders out there willing to lend, lots to do with that money, because when you're sitting in cash right now, you're losing purchasing power. So really the whole philosophy here is, let's keep rates low, to the fact that you're losing money if you're sitting in it. Go do something with that money and make the economy grow.
And so, stepping back, or big picture, what are you seeing right now in terms of the growth rate and the GDP figures in the United States as well as Canada? And also, of course, it was interesting because core PCE, so that's the preferred inflation measure of the Fed, did miss expectations.
It did. It was a bit lower, but again, it's a bit of a backward-looking number too. The U.S. is probably 3 to 4 months ahead of us in terms of recovery, and you see that. You see the full stadiums down there, and we sit here in our basements and watch all our sports. Things are starting to get better in the U.S., but we're still not there yet. PCE is personal consumption expenditure data. So what people are buying and what they're spending on, what's not really rising. It was missed expectations, but it still is rising. So we're getting there. Eventually, at some point in time, again, this is what we start to gauge is, so at what point in time do we start to pare back the bond purchases? And at what point in time do we start to raise interest rates again? And we're probably months away from the bond purchases drying up, and we're probably years still away from rates going higher.
So are you concerned that we might see a repeat of, I think it was Q4 2018, as it relates to a taper tantrum?
Taper tantrum. Yeah. It's, I think that's kind of baked in a little bit already. When you look at this is actually a very normal interest rate cycle. I mean, the level of rates is a lot lower than it's ever been before, right? But you've seen, 10-year yields go from below 1% to almost 2% now. I think we're probably about halfway through that move, but this is what always happens. So you have this depression or recession happening, bond rates tumble across the yield curve. The Fed starts cutting rates, right? And they've taken it down to zero. And then you get this natural, okay, well, this is where we are today. Let's price out the future. And this is where we're building in inflation expectations. We're building in growth expectations, and long yields start to rise. And when that difference between sort of 2-year bonds and 30-year bonds gets around 2.5%, 3%, that typically over the past cycles has signified the peak of the yield curve steepening. And after that, long yields tend to rise, tend to rally, fall a little bit. Bonds rally, yields fall a little bit. As the Fed gets ready to start hiking rates, they start hiking rates. Slowly, eventually, they invert the yield curve, and we start all over again, right? So I'd say, we're probably about halfway through this curve steepening, maybe a little more right now. So it still is a pretty bad environment for bonds because of that reason. But this is just a very natural cycle we're going through at this point in time.
What does that mean then for the equity markets? And everybody should know that you're head of trading and fixed income trading and securities lending. But how does that impact equity values?
So, again, from equity valuation, just looking at interest rates alone, when interest rates are so low, you could arguably justify a higher price earnings multiple on the equity market, right? Because earnings yield, the way to look at it from a bond guy perspective is instead of looking price over earnings, look at earnings over price. Like what's the earning yield on equities versus bonds right now? And yeah, at a PE of 20, it's still 5% versus the 1% you're getting in treasuries. Equities are still a good deal. The one thing maybe I'll take a step back though is over the long run, the equity risk premium has sit in that 5 to 6% area. That suggests, maybe equities are a little expensive here given the multiple the market's trading at compared to where 10-year bonds are right now. Mm-hmm. So, 6 months ago, it's like, yeah, buy equities, don't buy bonds because bonds are terrible. Now we're getting back towards more that equilibrium where, yes, you get a risk premium, but equities are probably a lot riskier, more volatile than just locking in at 2% from the Fed today, right? So we're getting back to more reasonable valuations in bonds. Equities have had a great run. I think, when you have a massive recovery in the fall, if it doesn't disappoint, equities can continue to run because earnings are going to be that good. But at some point in time, they're getting a bit expensive too.
Mm-hmm. Do you think though that, I think that you believe that we'll see about another percentage or so increase in the yield environment, right? So that's big. People should recognize that means that, the cost of borrowing, your credit card, your mortgage, your car payments, whatever, could go up.
Yep.
But do you think like the Fed thinks that will be transitory in nature?
See, the Fed transitory nature was, I think, more talking about near-term inflation. They think it's going to tone down a little bit as we get in the months ahead. We'll have to see. It's not something that the Fed can really control. They can try and influence, but they can't control it. So, with all this money out there, I'm a bit skeptical that things are not going to sort of run away. And you're seeing that really when you look at, especially the U.S. market, and tips are trading, at zero or negative yields. Right now, you've got to pay for inflation protection right now. And this is we haven't seen this before where tips yields were this negative. You've got to pay that much in case you have this inflation that just might happen. You're just not unexpected inflation could actually happen here. People are really still paying up for that. At some point in time, you need to get a real return on your money. And I think that's sort of the next shift here is, we've probably built in the right long-term inflation expectations, but the next move up is definitely going to be a rise in real yields that's going to drive everything higher. This is in my view. So as real yields go up, that's going to sort of detract from everything else too, right? You've got basically a shift in the underlying yields, the real cost of return on money right now. That'll sort of pare back what you're getting in other markets beyond fixed income at this point.
So what do you think that means in terms of people who have cash in their bank accounts? And I know you said, and people believe that, cash isn't your friend, but it is in some ways if you can kind of wait to see that real yield move higher and then lock in at a higher rate.
Right. And it's just, so the one thing is when cash is still probably better than bonds at this point in time overall. Let's face it, a 1% rise in yields just overall is probably going to see a 5, 6, maybe 7% negative return on Canadian bonds in terms of the benchmark universe index over the next 12 months, right? It's negative. You're going to lose money in bonds most likely. There's pockets of the bond market that'll do better than others, but overall fixed income is going to be a flat to negative return environment for the next little while. So yeah, cash is better than that, right? You're getting zero or next to zero. It's better than negative. So what do you do with that? And this is what's happening. You're getting pushed into doing lots of different things, be it, buying stocks, looking at alternative lending, be it private debt, high yields. High yields gotten expensive here too. I think maybe the latest advent that you should look at definitely if you're sitting in cash is maybe look at some of these long, short credit funds who are sort of have a neutral duration, but they're taking advantage of credit spreads. And it's obviously actively managed, right? But they're taking advantage of good credits and shorting the bad credits to sort of capture excess return. Alternative strategies should work fairly well in this type of environment, fixed income.
And are there many long, short credit funds in Canada, or are you looking at the States?
I just look at Canada. Again, they're mostly done as a mutual fund or alternative fund or LP type structure. As a Canadian, it's much more difficult to access a US fund for that reason. In Canada, there's a handful of funds. I don't want to get into names, some of the names for compliance reasons, but definitely there's a handful out there that do this type of business, and they've raised several $billion and they've been fairly successful. Some of them did have a couple of hiccups going through the March, April of last year when you did see that credit spreads blow out. There's always some NAV problems with bond funds back then, but most of them have managed fairly well through this as long as they stuck to their strategy. It didn't get into other things they should have been doing. So it's something to watch. Look at each of the managers and their track records, and there's some good funds out there for sure.
Okay, interesting. So be underweight long duration or going long bonds in the fixed income market because of the concern starting rates rising, and therefore the price goes down of the bonds, just so everybody's on the same page. Overweight. What's that?
Yeah, yields up, prices down. That's bonds for you. Yes.
Inverse relationship. Overweight these long short credit funds, and then you also say go overweight corporate versus government bonds. Maybe talk just a little bit about that. And so many people come on and say own corporate bonds, but not all corporate bonds are created equally. So we should get into some of those details as well.
Yeah. So it's just overall corporates versus governments right now. And we can argue, credit spreads are at pretty tight levels. I mean, they're close to historic tights, when high yields only giving you 4%, investment grades, only giving you 1.5. I mean, is that really great right now? Well, on an absolute basis, no. I mean, it's expensive, but let's remember. So investment grade corporates, let's say they yield, half percentage point more than government bonds do right now. That's very expensive, I guess, given the credit quality. But let's remember, like 5-year Canada bonds are only around 0.5%. So you get double the return buying corporates over buying governments right now. That will provide some cushion, right? I mean, as rates go up, I think, as the tide rises, all boats float. Well, same thing. As yields go up on government bonds, corporate bonds are going to sell off, similarly, but because they're already yielding more, they won't sell off as badly. Right. And that's the concept. You'll get a better return on corporates over this period than you will in governments for that simple reason alone. So that's why we're overweight corporates versus governments in this environment, just because your relative returns will be better. High yield, again, I guess it's expensive, but at least you're getting real returns at this point in time. I mean, high yield is going to give you a return in excess of inflation, even after defaults. Defaults should be falling. I mean, credit spreads should be tight because we're in an economic expansion. Credit defaults are going to continue to trickle off as hopefully these companies are making more money and paying off their debts, and they've got good access to cheap funding right now. So it's still a very constructive environment for high yields, similar to this for equities. I mean, the one thing I will say with high yield you have to watch though is high yield is much more correlated with equities in terms of its performance than it is with fixed income. So just be aware of that. It's when you're diversifying into high yield, you could just be buying stocks instead and probably doing just as well, if not better.
Especially with some of the dividends that are out there right now.
Agreed.
Yeah, and Joey, but sorry for 1 second here on corporates. What areas within corporate industry is what I mean look more interesting? Maybe are there any value opportunities in terms of where some of these bonds are priced and the rate that they're offering versus others?
I mean, in the higher end of the investment grade world, I do think the infrastructure names still look pretty good. I mean, and in the municipals too, I mean, compared to, provincials and Canada's, your airports, your pipelines, the ones with long life assets where the maturity of these bonds is less than the life of the asset being the important thing. And this is with pipelines, sometimes maybe you want to look at the bonds over the stock because you have a maturity date that's going to expire before we stop using oil. Right, just to throw it out there, right? It's going to extremes, right? So there's definitely good value in those types of names right now, just given the relative safety. They haven't been hot sectors. I think those probably look a little bit better than perhaps your telcos. Your banks are your benchmark; they're fair value. I don't think there's anything exciting there, except when we start talking about, and this is probably the most interesting part of the conversation, is LRCNs, as we call them, limited recourse capital notes, which are basically the new preferreds. I think there's great value there for those that are eligible to invest in them.
So I was going to ask you about that, of course. You and I have been talking about preferred shares for years, and you've been very forthright in terms of how preferreds have performed for retail investors. A lot of people have been hurt by them, and so we've always, over the past number of years, really tried to teach and tell people why that happened and what to be mindful of, and because I think that you would probably agree that there are still some opportunities in preferreds depending on the time of our conversation. But what you're talking about right now, the LRCNs, that's kind of the new preferred share class. So tell us a little bit about what they are, what they offer, and why maybe they're better.
Yeah, so just back up 1 second though, on preferreds, they've had a huge run for the last 12 months. They've actually beaten the TSX. They sold off just as hard as the TSX last March, but they rebounded very nicely since then. And then as LRCNs came into the market, they've rallied further. Now, why that is, I mean, let's talk about what an LRCN is. It's called a limited recourse capital note. Basically, it's, you know, below the subordinated debt even on the balance sheet. So if you go through a balance sheet, you've got your senior debt, your subordinated debt, your preferreds, and your equity. Well, these thought in as preferred shares, but a little bit different in terms of their structure, in that on the bank's balance sheet, they're bonds, but even though from a classification perspective, they rank equal to a preferred. So if the bank goes bankrupt, you know, you're the same as a pref, basically. You're all getting converted to equity, and you're probably getting nothing, right? So there's a lot more risk with these than there is with subordinated debt and senior debt, which have a better claim on the assets of whatever's left. So what's happened here is this year, I guess it was last year, actually, last second half of last year, the regulator OSFI came out and allowed the Canadian banks to issue these limited recourse capital notes to consider them tier 1 capital. Only a certain percentage. But when you look at, you know, Royal Bank, who, by the way, his market cap is bigger than the entire preferred share market, if you want to look at put things in perspective, right? They can issue up to 10% of their tier 1 capital as LRCNs. For them, they can issue these bonds, which they really are, even though they've got some bells and whistles to them, at interest rates that are probably equivalent to where they would issue preferred shares. But preferred shares are paying dividends out of after-tax money, whereas obviously the LRCNs are paying interest income, and that's tax deductible. So it's much better financing for the banks. It also has opened up to a different investor class, whereas, you know, a lot of institutions can't really look at preferreds because, as I pointed out, I mean, the whole market has less than a market cap of the bank itself. But these LRCNs are done in the institutional wholesale market where, you know, as a bond investor, you can go in, and your minimum piece is 200,000 on the new issue trade anyways. You can buy a sizable position, you get a big juice in yield. These things are probably yielding 3 to 4%, depending on the name right now, compared to obviously subordinated debt and senior debt yielding less than 2. So there's still a big pickup there, but it's still as much cheaper for the banks to issue them. So they've gone and done that, and they started calling away older preferred shares that are more expensive. And because of that, the preferred share market is shrinking. So there's this whole supply demand imbalance. You probably still have a good investor base looking at preferred still, but there's less and less product out there. So preferreds have continued to rally.
Interesting. There's a lot there, Joey, though, to understand, which is why people have advisors and invest in funds and tactical money managers. But so for right now, if somebody is saying, I've got some cash, I want to put it to work, what would you look at? An LRCN or LRCN or preferred share or both?
It depends. I mean, it depends. I think it's the key with prefers is you want to be buying them in a taxable account because you want the dividend tax credit because that's an extra 30%, right? Compared to what I mean, they were still fine to hold maybe in an RSP because they were yielding so much more than bonds were, but now they're not, right? So now you can actually go buy an LRCN in your tax sheltered account, and it makes way more sense to hold that there because it'll trade a little bit better than a preferred. You probably have better liquidity in the LRCN than you do in the preferred as well. For most investors, you know what, I do think prefers look cheap, holding them in your taxable account. Perhaps not as cheap as some of the common equity of these companies who are paying great dividends as well. But these, I mean, and historically, they've been historically prefers were more bond-like. They were less volatile. The last 10 years, they haven't been. They've been just as volatile as equities, providing less return. But think of the last 10 years, it's been a declining rate environment. At the same time, these banks and afterwards, you know, the pipelines and the telcos, they issue what are called rate reset preferred shares. There is a rate reset structure in the LRCNs as well. Every 5 years, the coupon changes. It's at a certain percentage point above where 5-year Canada bonds. They reset them every 5 years, they call them. So what happened with prefers was, and why they did so poorly, as rates were falling, guess what? Your dividend rate in the future was falling. So it's like a negative duration almost. As rates fall, prefers go down. As rates go up, because all of a sudden you've got a higher dividend stream or a higher chance of call, these things go up, right? So now we're starting to see the opposite happening, where, you know, rates are starting to rise here a bit again. And spreads have come in. They've got a new financing vehicle, so prefs will continue to do fairly well. So I guess, again, sitting on cash here right now, I would definitely still have an allocation to preferred shares in some shape or form. Knowing how liquid the market is, you probably want to go actively managed over passively managed. So there's funds out there. There's an actively managed ETF out there. Or if you really want to play sort of the rise in rates and the end of the rate resets at the banks, you buy an ETF or a fund that's mostly focused on rate resets over the entire broad market. Because there still is a lot of other stuff in that market that isn't the best quality that you probably want to avoid.
Okay. Joy, I do want to get to a couple of questions here from viewers. And this is from Ryan. For Joey, just curious what his thoughts are on floating rate prefs at these levels. They have had a good run. Does he still see upside in this area? If so, any names you could recommend? You kind of touched upon a lot of that, but what do you think?
Yep. I mean, so unfortunately, I can't mention specific issues or names for compliance reasons. We got to sign off on everything we talk about. Looking at floaters right now, and maybe I'll pare it back because a lot of these issues are coming up for reset, where you have the choice of going with a fixed rate, 5-year Canada bonds plus X percentage point, or you can float where your dividend will reset every 3 months at 3-month T-bills plus the same percentage point. So right now, there's definitely still a pretty good spread between a 5-year bond and a T-bill. Let's call it, for lack of better, about 3 rate hike difference here. So right now, this is looking at the reset part, do I want to go fixed or do I want to go floating? Well, do I think the Bank of Canada is going to hike more than 3 times in the next 5 years? Yes, probably, but I don't think they're going to do that for the next 2 years. So I think the cash flow on the fixed rate is going to be better on the floating rate. So anybody coming up for a reset right now, I'm still saying, go with fixed, don't go floating, or if you have a floating, go with fixed. You'll make more cash flow over the next 5 years with the fixed rate reset versus the floating rate. Now, when you want to compare someone that's not coming up for reset, it's very much, it depends, right? What's the yield looking like on these things right now? I mean, some of these floaters are actually yielding a bit more than the fixed rate right now. So if you can buy a floating rate preferred that has a pair that's fixed at a price that's cheaper than the fixed rate, then yeah, absolutely, they do look cheap here right now. Your dividend stream is a little bit lower, but that's going to probably correct over 2 years. Or even better, you have a chance to go for a reset and you can get called out perhaps at a point in time. So it really does depend. I mean, with the rise in rates in the next couple of years, they can make sense. But overall, I guess buying the rate resets that are floating rate, they can make sense right now, and they're still probably good value for sure.
And I'm going to stay away for 1 second, but I think a lot of people are also wondering, with respect to their mortgage rates, should they do fixed or variable?
Right.
What do you recommend?
The exact opposite there. I think it depends. I think you're never going to see fixed rates this low for a very long time. The other thing too, it's been always been worried with the floating rates is you're based off prime, not off of what you're with Bank of Canada rate per se. And the bank's been playing around with that spread for a while. They keep widening that spread out. So I'm a little distrustful perhaps of the banks doing that, or perhaps jacking prime rates up outside of the Bank of Canada. So because of that, I tend to go fixed. Right now I'd be locking in 5 years fixed or longer if I could at a very low rate and paying that off, because again, we think rates are going to go higher in the next 2 years. Probably a great time to lock in at below 2% on a 5-year mortgage. Absolutely lock it in.
Yeah, that's where I was leaning to, but good to hear your views. Because people are, everybody's buying a new home and looking at mortgages or refinancing. Let's take another one here, another question. And this we've touched upon this in our conversation, but could you ask Joey how far he thinks Fed debt monetization can go before we start to see negative consequences? Also, does the BOC have the same capacity to monetize debt as the Fed? Or are we more constrained as we are not the reserve currency?
Yeah, so again, I don't think it has a lot to do with it being the reserve currency per se, but I mean, the Bank of Canada, let's go back. I think it's that 50% level when the central bank owns more than half the market. That seems to be a bit of a tipping point where the central bank is concerned. You own more than half the market. Like, how free is this market really, and how good is that market going to be? So when they start to push up against that limit, they start to want to pare it back. And I think that's why the Bank of Canada already decided to do that. So to answer the question, yeah, I think the Bank of Canada has less room than the Fed does. The Fed's only sitting at about 40% right now. Obviously, they've got a much more massive amount of treasuries outstanding. So the Fed can keep going bigger and for longer than the Bank of Canada can at this point in time. But we're getting close to that point, where, unless they keep issuing bonds, which they will, at some point, the Bank of Canada and the Fed are going to have to start to pare things back. And that'll be very much an inflation situation too when they start to do that. But we'll have to watch it. But I think we're getting close in Canada for sure.
Okay. And Joey, this is from Brian. He said he purchased the ZPR, which is BMO's laddered preferred share index ETF about a year ago. It's been a great investment, marching steadily higher and pays a good dividend. What's your outlook for ZPR over the next 2 to 3 years?
Yeah, so that's the one I started talking about that focuses on the rate reset preferreds. That's going to continue to probably outperform the broader market over the next little while. Again, it's had a huge run. I think it continues to do well. given the environment we're in, but I think you've made the majority of your capital gains already. You're probably holding on this one now, maybe for a bit more capital gains as this market continues to shrink. I don't think there's a ton of run left in it. I'd also say the one thing I have with the preferred share ETFs, and this goes to all ETFs in general, when you have an ETF that passively tracks an illiquid market, you tend to have a lot of tracking error. ZPR has a lot. CPD is the other big preferred share one in Canada. A lot of tracking error right there. And then the problem is they basically tell you what they're going to be trading in the next couple of months, and they can get picked off by the trading desk because it's such an illiquid market. As this market gets more illiquid, I think that tracking error continues to get worse, and it's going to get tougher for them given the size of those funds compared to the size of the market right now.
Describe what a tracking error means.
So your tracking error is your performance versus the benchmark performance. There's always going to be a bit of a lag because the benchmark just doesn't have any transaction costs in it. But these have tended to do even worse than that, having a bigger tracking error than normal transaction costs would suggest. That just points out they're dealing in pretty illiquid markets. It's tough for them to really track a passive benchmark that doesn't have to account for that.
Okay. And that's really important depending on, which ETF you're buying, to understand the tracking and the tracking error and any kind of leakage as well from a trading perspective, correct?
Yeah. I mean, you see in equities too, like buying an S&P fund is never gonna be a problem. You're gonna have a very little tracking error. But when you get to small micro cap emerging market funds, there's definitely, what works academically when you don't have these trading frictions and bid offer spreads to deal with, and what actually works in the real world isn't the same, right? And that's the one thing to watch when you're buying all these ETFs out there.
And Joe, just stepping back a little bit here, what are you seeing in the market these days from a money flow perspective, sentiment perspective? Meaning, I think over the past number of weeks or even more so, it's been very quiet depending on which trading desk I'm talking to. So what's going on? What do you think people are doing? Are they sitting on their hands?
They're buying houses in Toronto, apparently.
That's true.
It's, it has been quiet. And with fixed income, that's not surprising. I mean, I mostly work with, retail investors, private wealth managers. They have been very quiet in fixed income for obvious reasons that, rates are just so low. It's hard to get excited. GICs are yielding more than corporate bonds right now. So we're seeing a lot of people buying GICs. Why wouldn't you? You're 100% insured by CDIC and you're getting more than you're getting on a triple B corporate. So we're seeing tons of money going there. We're seeing tons of money sitting on sidelines in the cash. And it's going, again, we're seeing a lot of money flowing into these alternative funds because they're chasing yield. Be careful what you chase. I mean, obviously we had a bit of a blow up here in Canada the last couple of days for completely unrelated market related reasons, right? But you've got to be careful what you buy too when you're looking at these types of funds.
Just describe what you saw over the past couple of days.
I mean, so bridging finance, obviously, I think it's been in the news. Again, it's interesting, and I don't want to comment because I don't know enough about what their holdings are, what the story is, but the OSC has put the funds into receivership, which I don't think we've ever seen that in Canada, or at least not in that I can recollect. But there's been no criminal charges laid as of so far. So it's a story we continue to watch. But it just goes to show when you're, again, bridging income fund was basically, they were doing a lot of private loans and debt. And as an investor, you could put money with them and capture much better yield than you would normally get by corporate bonds or high yield bonds. So, but it's a lot less liquid. So it's something to be careful of when you're looking at these types of funds that can be great enhancers. But as with everything, diversify and don't put all your eggs in one basket because these types of things can happen. I mean, you're going to be locked up in those funds for a while until the receiver takes a look at what's really there and can start to open up for redemptions again.
Mm-hmm. Yeah, it's so important to understand the risk parameters. And we all know that, especially the seniors or retired people who've worked so hard for their money and they're not making much money off of their money and they get kind of pushed up the risk curve. And that's been a risk that we've been talking about since the financial crisis, Joey.
Yeah. And then there's no free risk. There's no free lunch. I mean, obviously, something yields more for a reason, be it, liquidity reasons, and then you're locked in for a certain point in time, or there's credit quality reasons, or whatever it may be. When you're getting more, you're getting it for a reason. So just be careful what you're doing.
Right. And that's important to point out. The reason why you're getting more is because they're judged as riskier. Therefore, they've got to pay you more on your money to take your money and invest it. That's the bottom line here in the premise in terms of why you get paid more on an interest rate. It's not because they're nice. It's not because they're better. It's because of the risk return level.
Absolutely. And that's what it's all about. I mean, it's very quantitative fixed income. Like, the province of Ontario pays you 60 basis points more than the federal government because they are that much riskier. And we can go on and fit it until we get to 21% yields because you know what? You might not get your money back. Just be aware.
Joey, I'm spending a lot of time in the digital asset world, cryptocurrencies. And I love asking everybody what they think about it. And even if they're not involved, I think most people have a view. What do you, I guess, what's your view if you want to share it, but also what are you seeing in terms of how it might start to impact the fixed income world, new products, innovations, et cetera? Anything going on there?
Well, I'm still waiting for the first bond denominated in Bitcoin. Right? That'll come.
There you go.
I'm sure it'll come at some point in time. Again, I haven't done a deep dive into Bitcoin. I guess, I tend to look at Bitcoin more as equivalent to a gold or a store of value, as opposed to something that's going to be, I don't know all the mechanics behind it, but it's definitely more of a security or a gold or a real asset type of instrument. So that's Bitcoin in and of itself. Now, where I get more concerned is when I see, when the Bitcoin exchange, I think it was CoinHedge or something like that, trading at a bigger market cap than NASDAQ and the NYSE. I kind of go, well, hang on a second. These companies are making billions of dollars a year and they have lofty but reasonable, but at least like explainable valuations. How is this one exchange that just trades one thing going to be worth more? Oh, it's a tech company. Okay, well, beyond me, I'm a bond guy. I don't get it.
Yeah.
I don't get it. I don't pretend to get it. It is what it is. I think a lot of those things are definitely avoids if you don't get it. So for me personally, I've got no exposure to digital assets or currency or anything in my portfolio at this point in time, because I don't think it's a mature enough market to say, I want to put 5% of my portfolio into that at this point in time.
Yeah.
I'm watching. It's interesting, but let's see how this all plays out.
And I think we're starting to actually see more investment firms at least allow or have it available that investors can put up to 2% of their overall assets, just to kind of give people perspective in terms of, maybe the right allocation. I mean, that's up to everybody on an individual basis, but that 2% is a number I've seen out there.
Yep, and it's fair. I mean, I think it probably does deserve a place in your basket of real assets, along with real estate and gold and tips and RBs, which again, you're paying for inflation protection there. Maybe these are better. I think definitely it fits in the mix, but it's probably not going to be a majority holding of what you're into right now. So just be careful with that. But yeah, I think it's definitely worth a play, just to keep an eye on it.
And Joy, I just kind of want to wrap it up here with your thoughts on the Canadian dollar. Obviously, got a nice move on two fronts, really. Of course, the price of oil rallying, and then also, of course, the BOC's most recent decision to kind of pull back on that bond buying program, right. versus any other central bank. And for our viewers to understand, currencies really are to a degree a relative game as it relates to the expectations for interest rates, and also, of course, in this era, printing of money. So do you think that the Canadian dollar can stay at these levels? Will it move higher, or will it move lower, reflecting perhaps more of our economy versus the United States? And also, we are behind the United States in many, many countries as it relates to the vaccine rollout. And I'm talking 2 shots, not 1.
Yeah. So it's one thing that's definitely benefiting the dollar here too is interest rate differentials. I mean, in this, Canadian yields are higher than US yields going out to 6 years. So in the short end, which is where the whole, the futures market works on your interest rate parity, you've got carry there. If you buy Canadian dollars, sell US dollars, you can make a profit, right? And that's helping buoy the currency a little bit. That's in there too, along with oil prices. Even though our economic recovery is behind the US, it's probably ahead of a lot of the rest of the world. I know in Canada, we compare ourselves to the US first, maybe the UK second, 2 countries that are definitely further ahead of us in vaccines. But, we're a little bit ahead of Europe, the rest of Europe here right now. We're doing pretty well on that front. I mean, despite all the press around our vaccine strategy, we're actually doing pretty well compared to the rest of the world. I think we'll be able to open up domestically before a lot of the rest of the world. So for those reasons, Canada's probably a pretty good trade. Canada started off this pandemic in a better position than a lot of other countries did. When you look at federal and even federal and provincial combined debt to GDP, we started in a better place. We raised a lot more debt since then. It's up there. And I would even say I was pleasantly surprised that the federal government came out with a budget a year late, mind you. I'll criticize it for that, but they actually have a plan to restore some semblance of, deficit to GDP levels and, paying down some debt and growing the economy. And it wasn't unreasonable. We're just going to spend hundreds of billions of dollars and not have a plan. There is a measurable plan to get things, hopefully, in a better position than we are today. And we will get there. So I think a lot of those things have combined to make Canada a pretty attractive place right now compared to the rest of the world. So that's all pretty Canadian dollar positive. compared to other currencies, I think we're a little bit overvalued versus the US dollar here right now, though. You know, just again, interest rates are there, but again, the US is going to probably come out gangbusters. There's great opportunities to buy in the US, all probably ahead of us still. So for that reason, versus the US, I'd be a buyer US dollars here, but a buyer Canada over, say, euros at this point in time.
Okay, got it. We diverted to currencies, but it's all part of the same story in terms of the interest rate differentials, as you say, and country risk. Joey, thank you so much for being with us today. Appreciate your insights as always. It's nice to keep the conversations going, so thank you.
Absolutely, it's great to be on. It's great to do this.
Thank you. It's fun to have a longer conversation.
It is, without commercial interruptions. I appreciate it.
Exactly. All right, we'll leave it there. Thank you. We'll see you soon.
Thanks very much.
Okay, talk to you later. Okay.